The Fed just poured gasoline on the inflationary fire. You came here for the truth, so let me unveil that for you. Let me tell you, the Fed pivot is here. In today's video, I'm going to explain everything that happened at the Fed press conference, and of course, what it means for you. Many were surprised, many were shocked about what happened today, and I'm going to break it down in layman's terms so that we can all understand it. And I'm going to show you why this is so important coming into 2024. All the details, let's begin. You could see that the Fed holds rates steady and indicates that 3 cuts are coming in 2024. This was the big surprise because it was a shift in tone from Jerome Powell and the Federal Reserve. This is the actual press release. So, of course, as always, at 2 p.m., they release it. It comes out, the market reacts. Then at 2:30, Jerome Powell comes out on stage and the reporters start asking questions. They ask softball questions each and every time. Now, there was something right at the very end, and then he scurried off stage after he answered that question. That is very important, and I will break that down. It's related to the reverse repos and the reserves. I will break that down in a video that comes after this one because it's so in-depth, but we'll, of course, touch on that in this video today. I want you to note what happened, okay? Prior to the actual press conference, this article and many others like it came out, and basically what they said was Jerome Powell may push back on rate cuts at the press conference. And in fact, it was the opposite. It was quite the opposite. The Federal Reserve became, quote, dovish. And what that means is that they are willing to reduce their quantitative tightening at some point, though they have said we're going to continue on that path. They have said at some point in the near future, we're looking at cutting interest rates. And of course, we want a less restrictive policy. That's what he said. He also mentioned the fact that we are not going to wait, and I've said this before in the comment section many times, over the last while, that they are not going to wait for 2% and then start cutting rates. It's before they get to 2% that they start cutting slowly but surely, and that way it doesn't overshoot. Many people seemed, confused by that, but that's the way it works. And he actually said it after being asked that question. So let's get that out there right now. They're not waiting for 2% to start cutting rates. It's before that. So as long as they believe they're on the path to 2%, they're going to cut. And let's make it very clear and upfront, not real 2%, the measurement they use. Just like they're going to use their core PCE, the CPI, those measurements are what they are looking at. Fed pivots to rate cuts as inflation heads towards their 2% goal. So that's what's going on. This is being parroted out there in the media, and so we need to pay attention to it. This is what businesses use. This is what the media is going to, project. This is what the government is going to utilize for anything that they are doing. They are not using the real measurements, okay? That's why we need to know this stuff, even though it's manipulated. So this is a statement that was put out there, and basically what he said was it could just be a sign that the economy is normalizing and doesn't need the tight policy, right? And that's what's going on, because at this time, that's what the market is asking for. There's no question about it. That's what businesses are asking for, because they cannot sustain tight policy. And so they want to go to an easier policy. He made it clear that while quantitative tightening is going on now, at some point in the future, they want to stop that. This shows us that they are unwilling to ever let go of all of those assets that they hold. They got rid of about 1.2 trillion so far. Maybe that will come down. Is it going to be 1.5 trillion? Is it going to be 2 trillion? They're still holding on to, at the end of the day, over $7 trillion worth between the mortgage-backed securities and between the treasuries. This is something that it was unimaginable after the financial crisis Congress was saying, what are you doing? Why are you doing this exactly? Hold on. We got to ask you some questions. Now today, Congress and everybody else involved are saying, how much more can you do? This is criminal. This institution should not be involved in this at all. In 2020, they were buying mortgage-backed securities, sending the price of your homes going up, up, and up, making it completely unaffordable. Of course, in part, they were doing that. Keeping interest rates too low for too long was another part of that. There are many other things that were out of their control. But when you leave interest rates super low, the risk taking as a result is very clear and evident. So here we are. Nick Timiraos. He works for the Wall Street Journal. He was one of those people that asked the question during the press conference, and they call him the Fed Whisperer because the suggestion is they leak information to him, he brings it out in the Wall Street Journal, and then the public can react to it. And, it's kind of like an unspoken secret, but here it is, okay? He had this to say: the Powell pivot begins December 1st. It would be premature to speculate on when policy might ease. December 13th, rate cuts are something that begins to come into view and clearly is a topic of discussion. What a difference 2 weeks can make. So that's him. That's him saying that. He's using the words Powell pivot begins. They don't need to actually go and pivot on their policy because the forward guidance, like the words they use, come before that. That's what they do. When they get really strong, like it was very obvious when we moved through this, and I covered this very clearly through this part of the cycle, that they are going to do like Neel Kashkari, all the others out there in the Fed would be so harsh. Oh no, we're going to bring rates up this high. We're going to do this and we're going to do that before they actually do anything. And they do so because they can sort of get a little bit out of the market or what they are trying to achieve without actually taking any action on it. It works on the up, it works on the down. That's what's going on, okay? We have March Fed rate cut expectations at 75 basis points. So the market is saying we are going to see rate cuts, depending on which ones we're looking at, swaps, futures, these things. All you need to know is that the market is anticipating 3 rate cuts, 25 basis points each. And that's, with these things, you'll see these dot plots, or the SEP as it is called. This is just, think of it like the FOMC. All these members, they are going to sit down and say, okay, where do I think the Fed funds rate is going to be at in 2023, 2024, 2025, and so on. And you could see the trajectory and where they believe that over the next few years that will go down. But the market, that green line down there, they believe it's going to be a lot lower than where the Federal Reserve members do. And so, just the long and short of it is that 3 cuts. They're expecting 3 cuts very soon. So who knows where that will end up? It all depends on, are we going into a recession? If we go into a recession, is it going to be that soft landing? Is it going to be harsh? That's one aspect. If there's no recession, they start to, decrease interest rates and, things start to calm down, cool down, mortgage rates go down. We start to see a little bit more inventory getting bought up. Sales start to happen again. Everything starts to ease. But what happens here? Prices of stuff, whatever that is, will likely continue to go up. That's a big concern. And I know there's some people out there, I've seen your comments, that say, but that's going to be like the 1970s. That's going to create more inflation. And as a result, they'll need to increase interest rates yet again. Look, they might increase at some point. They might. That's for sure. But you got to understand the policies of the Federal Reserve are designed to create inflation. It's not an accident. It's not ignorance. This is intentional. Why would they do that? Well, of course, when they do this as part of a cycle, they are trying to create a bigger and bigger gap in between the rich and the poor. And so if we have the rich on top, we have the poor, we got the middle class in the middle, they want to squeeze that down so that we have a very few rich at the top and everybody else at the bottom. And you do so through an inflationary policy, not through deflation. Deflation levels the playing field because all those with assets suddenly, not worth so much. Of course, if they have cash on hand and things that they could buy things for pennies on the dollar, we did see that basically many, many times before, but it's the inflation which is helping out the richest of the rich, not the deflation. Okay? Keep that in mind. Economists who've said that it's going to require very high unemployment to get this done are eating their words. Who said it? My favorite, Janet Yellen. It doesn't seem like it at all. It's requiring higher unemployment. So at this time, 3.7% on the U3 unemployment rate, not the real unemployment rate, but the one that they like to show you from the BLS. Is that BLS or is it BS? Anyway, so that's just telling us that basically, when we measure it that way, certainly, you don't have to have that higher unemployment. You don't have to acknowledge the fact that people have 2 jobs and 3 jobs and 4 jobs. That's fine. But what it tells you is that if the trend continues, they could start to cut interest rates. They could leave their balance sheet at $7+ trillion, and it would create more gasoline on the inflationary fire. Asset prices could continue to rise. Look, I was arguing with countless people on that Warren Buffett video I did recently. They didn't watch the video because I said over and over again that I talk about inflation, not a collapse where everything suddenly loses value, though we could have that happen. The most likely circumstance is inflation. Even if there is a period of deflation, they will turn around and they will inflate the heck out of it. That's what I'm talking about. And I pinpointed the exact bottom of the stock market back last year. Why? Because I follow the money mirror method. It's not something that is ingenious or anything. I just kind of coined the term and I've been able to track it. Anybody that's on the Finance Friday live sessions knows all about that. And I'm going to break that down further in the next video after this one. So you've got to like this video, you got to subscribe to make sure that you're going to be notified of tomorrow's video. This likely won't end up in your feed for the vast majority of people anyway. We're going to talk about, the reverse repos. We're going to talk about the reserves. And we will also talk about this. The Treasury buyback plan will boost market resilience. That's right. The buybacks. Now, you've heard of share buybacks done by companies all over the place, but Treasury can do so. And they can buy back their own debt. It's a very, very some circle voodoo nonsense that they've got going on, just like the Federal Reserve does. But that's coming in 2024. They say that they are going to do that. And I think it's really important that we pay attention to this because it's just more and more and more of the same. They're trying to create liquidity. But what are they concerned about? Interesting. Okay. The comment of the day says, we know the Fed pivots, asset prices will explode and inflation will spike. The Fed will be backed into a Volcker corner. So nothing is off the table. And I said this, never assume that the Fed wants to do what they say they'll do. And that's the thing. It's like, you got to take it with a grain of salt and understand what they're really up to. It's not necessarily all true, right? That's very important. Look, if you want to get the details, you want to be on top of it, you've got to go to my website. You've got to go here and, there's 3 things. That is Compass, number 1, which is a free financial education program. You go through it. It takes like 20 minutes. It's super simple. Over 1,000 people have been through it. Totally free. No paywall. No email address needed. Nothing. Go in there. It's Compass, okay? You also have Money Pickle. If you're in that pickle, you got yourself in some hot water or something, or you just want a second opinion, go there. You will get a CFP or fiduciary. You can book a call with them, a 45-minute free call with them. Link will be in the description. I hope that you found this informative. If you did, hit that thumbs up button. But look, tomorrow's video is going to be massive. Okay, it needed its own separate video. And I hope to see you there. I'll see you on the next one. Take care.